So give us, first of all, the overview. Going into this week, there was a fair amount of optimism given those great jobs numbers. Did the market get too far ahead of itself? Is that what happened when we had that big downturn on Thursday?
Yeah, so first of all, thank you so much, David, for having me on the program. And I do have an idea for you at the outset, which is to rename this program Wall Street Month, because literally every week in this crisis feels like it's been a month, and this one's no different. But this question that you're asking is what all of our clients are asking. Have markets gotten too ahead of themselves, and really what happened this week? So let me just take a step back and tell you a little bit about where we think we are, and then I'll make a couple of comments about where we're going. So overall, equity markets now down about 5% on the year, recovered 35% from their lows. But that really doesn't tell the whole story. The whole story is more complicated. You have large cap growth markets are up in positive territory, and pretty much every other market in the US as well as around the world is down 10% or more. And in fact, the median stock in the S&P 500 is still down more than 20%. So overall markets are resilient, but within that, there is still some dislocation and some opportunity. And then in terms of where we're going to go from here, and should we be optimistic, I'll give three reasons that I think we should feel good, and one important reason that we might want to be cautious. So on the feel good side, we have a central bank that's highly committed to putting liquidity into the market, which reduces left tail risks for equity markets. Second point we would make is what you've already referred to, which is a very strong economy with the biggest upside surprise in labor markets really in history announced last Friday. We'll need to monitor that to make sure that we get more improvement, and it's sticky, but that's certainly supportive. And then third, we on the virus front, we are having some better news. So reopenings are going better, particularly in Europe. On the reason to be worried front, I just want to point to valuations. So valuations at best are on a 20 times price to earnings multiple. And that's really twice as expensive as we were at the depths of the financial crisis, and more expensive than we were at the beginning of last year. And so people need to be cautious around the price that they're paying for these equity markets. Pulling all of that together, we do think people should remain invested, but we think they need to be highly selective in terms of where to look for the opportunities. But given the dispersion that you already referred to, it's actually the highest it's been in 10 years. There's really never been a better opportunity for active management.
So, Katie, there was one of the things that was discussed a lot over the last couple of weeks is maybe a possible rotation. It had been sort of the stay-at-home stocks, which include a lot of those large-cap growth stocks you said are doing terribly well. And then we thought we saw it moving away from that more to sort of the recovery stocks. It's gone back and forth. How do you analyze that rotation? Has it been happening? Is it going to happen?
Yeah, so we have had a rotation. We've had some really dramatic moves in cyclically depressed names. So let's talk a little bit about what's driving that, and then I'll tell you how we're invested in that. So the retail investor has been extremely active in these deeply depressed cyclical names. And just to give some kind of context behind that, we look at volumes for retail investors. Ameritrade had some data out earlier this week that shows that volumes for retail investors are up 300% year over year. And they are bidding these more depressed parts of the market. So we saw Hertz, for example, was up 1,500% off of its lows earlier this week. And you have this very odd situation where you have a company that's effectively filing for bankruptcy and at the same time is making an equity offering. So retail investors are in net outflow for equities for the year, but they're really bidding this highly cyclical part of the market, which is driving some big moves there. From our perspective, we're very long-term investors and we like secular growth stories. So we're not involved in a lot of these dislocated names, but what we are invested in is companies that are beneficiaries of that volume. So we own the wealth managers, the online brokerage companies, and also the exchanges, which benefit from that volume. But what we really like is long-term secular growth stories trading at reasonable valuations.
So long-term secular growth stories, that makes good sense. Do you also pick, according to balance sheet, according to credit risk, things like that? Given the uncertainty here, do you have to make sure your company's going to make it?
Yeah, that's 100% correct, David. So the number one thing in this environment, because really we all have to have the humility to know we don't know how long it's going to last, is to underwrite that those balance sheets can get these companies to the proverbial other side. In terms of some areas of secular growth that we are invested in and we like, I'll highlight three to you. The first would be in the supply chain space, the idea of localization of supply chains and the beneficiaries of that, which are advanced manufacturing. So we do think that the law of comparative economics is going to hold. in aggregate. But some companies are going to have to localize the most vulnerable parts of their supply chain and move from just in time to just in case, particularly true in the semi space and in healthcare. So we like the companies that are beneficiaries of doing that more efficiently, because as they localize, they're going to have to control for labor costs and manufacture more efficiently. So Rockwell Automation would be an example of a company there. Second space, of course, would be e-commerce. As a third of the world has been in lockdown, we've all had to live more of our life online. Just to put that into context for you, we've had what we thought would take 8 years to increase internet penetration. We've gone from about 15% of stuff being sold via e-commerce to 25%. We thought that would take us another 8 years. We got there in 8 weeks. And so we like the companies facilitating that e-commerce trend. One example of that would be Shopify. They actually give small businesses the tools to create a digital storefront. And the really interesting part about this is that those small businesses can actually sell from their own website, and they don't have to go to a big marketplace like Amazon, where they could get disintermediated from the client. So that's an interesting company. And then finally, I would highlight the intersection of technology and healthcare. And in that space, we like medical devices and robotic surgery in particular.